Cybercrime is estimated to cost the world roughly $10 trillion in 2025, which, to put into perspective how large this is, it would be larger than any standalone economy in the world besides the US and China. To counter this, the global spend on cybersecurity is around $200 billion a year and grown at a CAGR of 12% a year for the foreseeable future. Lots of business here for these cybersecurity companies to capture in the decades ahead, especially as AI just accelerates the sophistication of cyber attacks. In the last 5 years, Palo Alto Networks has crushed the return of the S&P and is the largest pure-play cybersecurity company in the world with a market cap well over $100 billion. Let's cover Palo Alto Networks now to determine if they can outperform in the next 5 years as well. To best understand how Palo Alto Networks differs from other popular cybersecurity firms, let's use a castle analogy. In this case, Palo Alto Networks' role is to stop enemies from entering into the castle. So it would be the main fortress walls and the guards monitoring the front door. Now suppose there was a stealth infiltration and the enemy dresses up like a guard so it can walk right through the front door undetected. Crowdstrike comes in and monitors every person's actions within the castle. If that guard goes to the treasury, Crowdstrike can flag that as suspicious and instantly shut it down. Continue with this example and suppose this fake guard was able to steal a key. Fortunately, the key only works for one room. Thanks to Zscaler's Zero Trust defense, every employee within the castle only has access to a specific room that they should be allowed in, while the rest of the castle remains locked away under specific keys. Finally, we have Rubrik. Suppose the enemy successfully infiltrates the castle's defenses and steals the crown jewels. Rubrik is essentially a reset button that will restore the latest version of the crown jewels. It essentially is the last line of defense. All four of these companies have an important role to play in their primary defense objectives. The reason we like Palo Alto Networks the most is they're aiming to expand into a keyword they've called platformization, which means move beyond its historical strength and consolidate a client's services and cybersecurity spend all under one vendor, them. The main thesis for investing in Palo Alto Networks versus bets in other cybersecurity companies is a belief this platformization strategy will continue to play out and drive high growth and sticky revenue. This is, after all, a product that customers have been requesting, as currently the cybersecurity segment is too fragmented. Many large companies are using dozens of different security products, which drive an inferior experience as the products don't integrate well together. Furthermore, these systems mean more trainings and uncoordinated alerts from each, which means more overhead costs for the customer to maintain. A platform allows, overall, for less overhead spend and greater efficiency. In addition to a better and cheaper customer experience, platformization will theoretically also drive a better product by maximizing the impact of AI. Having a unified platform is the most efficient way to collect, structure, and feed data from all these security domains like network, cloud, endpoint into a central AI engine to evaluate. Since Palo Alto Networks has announced the strategic priority in late 2023, it has so far proven successful. They've grown from 900 to 1,400 total platformizations today. The original concern when they first announced the strategy was that they were providing discounts for bundling, which short-term was a hit to their profit margins. As you can see here, they are able to continue to grow their industry-lean free cash flow, which by 2028, they're targeting to grow this free cash flow margin to an incredible 40%. Palo Alto Networks is well on target to hit their $15 billion annualized recurring rate and 3,000 total platformizations by 2030, which, with a 40% free cash flow margin, will be generating tons of free cash flow. Not one for complacency, Palo Alto Networks continues to strengthen their platform offerings outside of their core networking and SASE by acquiring identity access management firm CyberRK recently for $25 billion. This has been a multi-year plan for Palo Alto Networks to execute on strategic acquisitions to be able to build a fully integrated platform, so it would be a challenge for competitors to fully catch up to offer the same broad offerings. With the favorable secular tailwinds of cybersecurity, followed by top dog status with a platform that can generate greater than 40% free cash flow margins. Palo Alto Networks seems like a no-brainer for our portfolio, but what is holding them back is valuation. Before we get into valuation, please read the disclaimer in the notes below. We are not financial advisors, nor anything we say should be taken as financial advice. Also, if you like content like this, please help us out and click subscribe, as we aim to review long-term, innovative-focused companies twice per week. Now let's look at valuation. From a valuation perspective, I have Palo Alto Networks on a cusp of transitioning from a growth company to one focused on generating tons of free cash flow. Their platformization focus will enable greater operating leverage and thus better free cash flow margins of greater than 40%. In the meantime, average CAGR I expect is 10 to 15% growth in revenue, which is good, but not great, which makes sense as Palo Alto Networks is a mature and profitable company focused on generating significant cash flow. Thus, the adjusted free cash flow is a metric I will be using to evaluate them on for evaluation. Looking at Palo Alto Networks, the historical price to free cash flow ratio between 2016 and 2020 is between 15 to 25. In the past couple years, though, this multiple trades at between 30 to 40 now. So there has been multiple expansion far greater and faster than free cash flow growth. I do believe as this company matures and revenue growth slows down, it reverts back to the 15 to 25 price to free cash flow multiple. So looking at a 2030 price target, let's start off with revenue for 2030. I assume $16.5 billion, as Palo Alto Networks states that their target is $15 billion of revenue on next generation security, which I assume makes up 90% of revenue. I then assume that they hit their target of 40% adjusted free cash flow margins, and then I apply that 25 price to free cash flow ratio, which would give me a 2030 market cap of $165 billion, or $244 a share. For me to feel good about valuation, I would want to buy Palo Alto Networks at a roughly $82 billion market cap to give myself a target 15% annualized return. Now let's evaluate Palo Alto Networks through my 5-point framework. From a leadership perspective, I give them a strong. CEO Nikesh Arora has been in charge since 2018 and has been instrumental in setting Palo Alto Networks up to transform from a network security vendor into a comprehensive cybersecurity platform provider. I applaud him for his long-term vision when in 2023 he alluded to short-term pains related to this transformation to enable long-term growth. From a valuation perspective, I give Palo Alto Networks a very weak. My 2030 price target shows that in 2030, the fundamentals support a stock price of $244, which is well below my 15% target annual returns. For revenue and profit growth, I give this a neutral. The revenue growth of 10 to 15% is just okay, especially for a company with this premium of a valuation. Profit, though, is impressive if they can gain operating leverage to become a 40+% free cash flow margin. For large total addressable market, I give this a strong. Currently, the global spend is a massive $200 billion and growing at a 12% CAGR. This is a huge size of pie for Palo Alto Networks to capture, considering that even though they are the largest pure-play cybersecurity firm, they capture only $9 billion of this $200 billion in global spend. Lastly, for secular tailwinds, I give this a very strong. Cybersecurity is resilient against any economic cycle as the cost of a breach is just too massive, and AI will cause a greater need for more spend as attacks become more sophisticated. Overall, I am impressed with Palo Alto Networks from a business perspective. They are a top dog in an ever-increasing important segment and continue to improve their platform offering. I'm a no to buy the stock now, though, as valuation is just way too overpriced. It will need to drop by magnitude of 30 to 40% for me to revisit. What do you think, Dad?
Yes, thank you, Scott, for that excellent analysis. So yes, I'm going to review my take on Palo Alto Networks. For the company fundamentals, first of all, the dividend is 0%. The beta is 0.98, which means it's very similar to the S&P 500, almost exactly like the S&P 500, very close. The market cap is $148 billion, and the earnings comes out on November 20th, so that's a neutral to positive. For the earnings history of the last 4 quarters, it beat all 4 quarters. So that's a positive. For the financials, the net profit margin is 12.3%. The debt to equity is 0%. And the non-GAAP PEG ratio is 2.8. So that's a neutral to positive as well. And now we'll go to the Bollinger Bands. And for the Bollinger Bands, as you can see, it's pretty consistent. You know, it's not that wide, the bands, as you could see. So it was wide before volatile, but anyway, it's hugging the upper band, and that's very unusual. Like I've mentioned before, 5 times out of 100 trades, it's out of the band, and it's almost out of the upper band right now. So anyway, it looks good, but I don't see how it could continue to keep up this pace. So I'm thinking maybe it retreats back to the middle band, which is around 205, or maybe the lower band, which is around 196. And then for the moving average, 50 days above the 200 day, as you could see. The 200 day is sloping positive, and the price is above both the 50 and 200. And the slow stochastic oscillator, which measures momentum, is at an 80, which means it's pretty close to being overbought. Overbought is an 80 and up. So that also leads me to believe that it's going to retreat back to the middle band at least, but that's just my take. The MACD is neutral, and then the unbalanced volume is positive. Overall, it's a neutral to positive. And then for the analysts I cover, there's 5 holds, 10 buys, and 1 strong buy. And the institutional percentage of institutions holding the shares are 77%, which is pretty good, which means it really shouldn't go down that much. Because of that, it dampens the volatility a little bit. So anyway, my take, Scott, is to either a third to a half a position around 205 at this point. So let's see what happens. But that's my take on the technicals for Palo Alto Networks. So back to you, Scott.
Thanks, Dad. Palo Alto Networks is a phenomenal company riding an incredible tailwind that will truly be accelerated with advancements in AI triggering more attacks. Every week, it seems like we hear about another cyber attack, with this week's high-profile breach being Salesforce. However, despite Palo Alto Networks being a solid company, the valuation is just too rich to be added now, so we will be looking out for other cybersecurity companies for our portfolio. That said, thank you for watching. Please help us out and click like and subscribe. Until next time, happy investing.